So according to a Fortune.com article, Jerome Powell, who's head of the Federal Reserve, has paused the June interest rate hike. No surprise there, right?
No, I shouldn't think it should be surprising. There's been enough financial pain so far that they're going to stop and evaluate and see, because what they've done, the interest rates hikes they've done so far, still haven't completely worked their way through the system. They say it's around 18 to 24 months. We're not even 12 months into this rate cycle, I don't think, from memory. So we've got a ways to go yet. So they're kind of forced into a pause because, I mean, you got billionaires going on CNBC crying, oh, stop the rate hike, we're going to go bankrupt, and some of them are. So it's inevitable that they're going to create a certain amount of pain and then reevaluate and wait. All right.
Yeah. He's actually admitted that some banks are in trouble with their commercial real estate holdings, and he stated, we do expect losses.
Yeah, that's very telling because
very telling.
I mean, from memory, if I go back to 2008, I don't remember anybody ever admitting to anything. It was, I remember the big phrase was green shoots. Remember that? Green shoots. And all the people that were critics of it were going, oh yeah, green shoots. Yeah, sure. The economy's recovering right before it really tanked, right? So they never once admitted to anything in my recollection in 2008. So it's very telling that they're admitting to anything. It's almost like, look, this is too big. We can't keep a lid on this. We've got to give them something, some sort of warning shot across the bow. And that's what I call that.
Yeah. And then he went on to tell reporters that he's keeping an eye on commercial real estate and watching the situation very carefully. Again, how telling is that?
Mm-hmm.
I mean, he's basically telling you, folks.
Yeah, they're giving you the bullseye too, that it's commercial real estate. I mean, it just stands to reason. I mean, residential real estate mortgage obligations were the big elephant in the room in 2008, and they got sort of cleaned out to a degree. So commercial real estate got a pass and kept on sailing, I guess, right? So their liquidity squeeze is going to be even greater.
Yeah.
And that's what they're going through. None of them can pay their bills. Like all the big office places are down, 15, 20% occupancy, and it's not turning around. So this is where they're at. Commercial, it seems like the commercial real estate obligations are going to be the fuse.
Yeah, it's quite something that he's actually telling the public that they're watching it very carefully. I mean, whoa, that is saying, hey, something can happen here,
Yeah, that says a lot that they're watching it. Because again, I can repeat, if you can, I mean, I could be wrong. If they admitted to anything in 2008, 2009, I didn't hear it. And I was following it pretty close, so.
Yeah. There's a substantial amount of commercial real estate in banking system. Okay, so this is largely in smaller banks, right?
Yeah, this whole regional versus Federal Reserve banks thing in the US.
Yeah. And then for those smaller banks that have larger concentrations of commercial real estate loans, he says those banks will experience larger losses. So he's not just saying some losses. Now those banks will have larger losses. So he's revealing more again.
Well, that goes back to the Janet Yellen statement when questioned in Congress about who was going to get protected and bailed out. And they basically, in a roundabout way, said, we'll bail out who we feel like.
Yeah.
And you know what that's going to be. They're going to pick their friends, which is the Federal Reserve side. So all these regional banks have the potential to get hung out to dry in that one statement. And people that were paying attention heard that too. Everybody's talking about it. So it's a real thing.
It's a real thing. I've heard people quote that they're getting slaughtered. Anyway, estimates surrounding how much of commercial real estate debt is concentrated within small banks varies, but Goldman Sachs previously suggested that lenders with less than 250 billion in assets account for roughly 80% of commercial real estate loans. So they're going to get hit hard, these small banks.
Yep.
80%.
Yeah, if they're that stacked up on commercial real estate, this is not going to be good.
Yeah, so when he says expect losses, and then expect larger losses. Are we talking just losses or complete collapses here? I mean, if they have 80%, I mean, are you just going to lose or are you going to totally lose? You see what I'm asking?
Most of them will end up getting restructured. I mean, they'll
Mhm.
move over into some other asset class, residential real estate or something. But I just heard there was a billionaire. I was making the joke about a guy going on CNN and crying, or CNBC and crying about the situation. This billionaire, I forget his name, but some guys I was just listening to talk about him. He's dumping 2,000 units on the market, right? So,
Oh,
and
yeah, I heard that.
he's the one we're hearing about.
Yeah,
Right. Here's the one we're hearing about. It's like Evergrande in China, right? Everybody heard about Evergrande last year and then it kind of just faded away. But Evergrande is in trouble. But every big construction company in China is in trouble. They just talk only about Evergrande. It's like the release valve. We got to talk about something so we're not seen as holding out and not covering it. You know, we have to
right.
give coverage. So they pick their, one narrative to talk about, and then it just goes down the memory hole and we're on to the next thing. But it doesn't change the problem. Banks, basically, the government has come out in China and said, you can't borrow to all these big construction companies. You can't borrow any more money. You're done. You're cut off.
You were telling me, yeah.
Yeah, you're cut
Yeah.
off. Now, how bad does it have to get for them to literally make a government diktat that you're cut off? So nobody's being spared here. It's bad, or it's bad everywhere.
Yeah, yeah. And then I have to ask, how many of these small banks, I don't know if you would know, in the US, that apparently have 80% of these commercial real estate loans, how many of those small banks are there that are in that situation? Because
Well,
how many small banks are there? There's a number. How many?
it's
Do you
around
know?
5,000. It's around
Okay,
5,000.
so
Yeah.
out of 5,000, you got to wonder how many are in that situation.
Well, I don't
Because
know.
isn't it small banks that do take on a lot of this commercial real estate?
You'd have to do a little bit of digging,
Yeah,
because those numbers, they don't always come out like right away. We're not always up to date. Like they say, economists love to report on what happened, not what's going to happen. So
yeah,
we always wait for the real numbers to come out, and there's always delay in that data. So when things are moving as fast as they are right now, it it's kind of difficult because in a couple of months, so much could change. And if their data updates are only quarterly, you could end up at the end of a quarter and go, "What happened? We're insolvent."
yeah,
Just in
yeah,
that quick, right? When it starts to turn, it's like the old joke. A guy asked, "How did you go bankrupt?" And he said, "First gradually, then suddenly," right? And
yeah,
we're getting very close to the suddenly, I think, in my opinion.
yeah, yeah. Commercial real estate made up 45% of the loan portfolios of Signature Bank, which collapsed back in March.
Yep,
So
there you go. So, right.
and that was only 4 to 5% and it collapsed. Now some of these are at 80.
Yeah, and this is the way it rolled out in '08 too. There was, a couple of things, and then, some talk and everything's okay, and then a few more, and then it just continued on. And I think it was like 70 or 80 institutions went down in '08, but we only ever heard about, the big ones, Bear Stearns, Lehman, Washington Mutual, right? But there
Yeah,
was a lot of smaller institutions that were wiped out too. And
yeah,
going to be the same, in my opinion, this time. It's just going to be bigger. I mean, the losses already are in the banking sector are bigger now than they were in '08. We know that. We have the charts to prove it.
right.
So
I don't think a lot of people realize that though.
no, nobody
That's a big,
does.
big, big deal.
Well, our trust system is called a trust system for a reason, and because it can be destroyed by a lack of trust. And
Yeah.
so, where does trust come from? Faith and belief that things are okay. If
Mm-hmm.
you don't believe things are going to be okay, where's your trust? It's gone. And
Mm-hmm.
once we start alarming the public, this is why I'm surprised they're saying anything. I guess they're just hoping nobody's paying attention.
Yeah. Yeah.
Um, but this is the reason they don't talk about it, because it will literally create a self-fulfilling event
Well,
once
this
you
is
start
their
talking about it.
little, yeah, this is their little cushion on that when you were saying. So they go on, Powell goes on to say, it feels like something that will be around for some time. And he
More
says,
euphemisms.
as opposed to something that will suddenly hit and work its way to systematic risk. Like whoa, that's almost opposite of what you're saying here.
Yeah,
We're
well,
watching it carefully, but oh, it's gonna drag out. It's gonna, what that's the cushion right there, right? Making
Yeah.
everybody, oh, it's okay, it's okay.
Yeah, they use all the language softening stuff and avoidance techniques. It's all, right. Try not to say anything and sound like you said something.
Yeah.
Or just hide the real true intent of what you're saying to some degree, so that only the really smart, people that are really listening carefully get it, right?
Yeah. Or this whole contain thing, he's saying it's contained to what? Small banks, which is okay for you.
Yeah, because we don't care about them. They'll just get absorbed by the big banks. I mean, that's what it seems like is happening here, is that the system in the US, I guess they feel that, it's too many banks. I mean, some people say there are too many banks. I mean, that's an arbitrary argument. I mean, I don't know how many is too many. But I think what they'd like to do is reduce that number. So, I mean, obviously, if you have to negotiate with a lot more banks, it's going to be harder to get the outcome you want, to get control over the system. And that's what they want. They want control. You can understand them wanting that control, but at what cost, right?
Yeah. So what do we got here? Everything that's happening with commercial real estate is because the sector is vulnerable to high inflation and high interest rates, particularly because it's largely built on debt.
Well, everything's built on debt. I mean, this is our system.
I know.
So that isn't a fair assessment to say it's built on debt, even though it's true.
Yeah.
That doesn't stand out.
Yeah.
Yeah.
Yeah. So it has become more difficult and expensive for borrowers to get a loan or refinance an existing loan once it matures. So there's the pickle.
It's the same thing in the housing industry right now. Look, if you've got residential mortgages where they're pushing the excess owing, what people can't pay, out to the end of the mortgage and extending their amortization, a lot of those people, as we stated before, are not paying anything down on their principal. Right? So what are the implications of that? Well, the implications are you can't move because you have no equity in your house.
Yeah.
Right? So why is nobody moving right now? Why is nobody buying? Well, they are. I mean, I'm not saying nobody, but it's slowed down a lot. The very few houses that are coming up for sale are selling. But the reality is the bidding is going to go down because most people don't have the equity to move.
Yeah. Yeah.
Right? They can't qualify because all the qualifications have changed, and they don't have the equity in their house because of their current situation. So we have a bunch of zombie homeowners, at least from a financial standpoint. I don't mean zombie as, human zombies, but their financial situation is basically a zombie situation where there's nowhere to negotiate, nothing.
Yeah, isn't that something?
Yeah, and that epiphany just occurred to me yesterday. I went, oh my God, that's why they can't move. That's why people aren't bidding, because they literally don't qualify. They can't qualify. They have nothing to qualify for. Just completely escaped me until yesterday. I was like, that's the problem.
Yeah.
Like, I'm no mortgage or housing expert. I know numbers and know my math, and I know the financial system, but the intricate details, I have to listen a little bit more than the average person to get it. Once I get it, but that escaped me, and I went, okay, that's the linchpin.
It makes sense to me.
Yeah, it's simple when you get past all the terminology and the gobbledygook stuff, and you just reduce it to basics, and you go, that's all they're talking about. And that's an important distinction, folks. Like I always tell people, I'm not the world's foremost expert on finance. There's a lot of terms I don't understand, but when people are talking, I'll often say, well, I need to understand that term to know what they're talking about. And a lot of times, if you'll just take the time to pause and go look stuff up, you'll find the conversation gets a lot clearer. And it's on you if you don't. I mean, we all need to join this conversation. More people need to join this conversation, and because the solutions to this are going to be bad.
Yeah, because what they're saying here is the current environment of higher interest rates coupled with tighter lending standards following the bank failures will likely result in an increase in delinquencies and defaults.
Yeah, it's already happening. Again, we're just not talking about it. It's right there. I mean, look at the car repo market in the US. Those numbers are way up, and that hasn't got anything to do with housing, but it's all based on credit. And smaller ticket items are going to get hit earlier because smaller ticket items like cars, like people buy extra cars they don't need, right? I just want that Ford Mustang, or whatever car you're after. And so when the credit squeeze starts, those are the first things to get hit.
Yeah.
But that's a succession. Right now, it's going to bleed into larger areas of credit, including housing and commercial real estate. But
Yeah.
the auto market, the auto repo market is just a forward indicator. It's like the RV indicator. People stop buying RVs because no one really needs an RV. And so
Right.
when credit gets tight and money gets tight and employment's rising and everything else, people stop buying things like RVs immediately. It just doesn't even come up as a choice or an option.
It's
So
a
those
great,
are good leading indicators. Yeah.
yes, it's a RV especially is a great indicator because that's really caters to the middle class. The wealthy really, you don't buy a lot of RVs, I don't think.
Yeah. Yeah. Leading indicators are important because, you know, these things tend to happen the same every time. So if you want to know where you are in this financial landscape and where it's going, just compare leading indicators and it's pretty obvious. But this is not the domain of the average working and middle class person. But I think it needs to be to a degree. Like,
Yeah.
yeah,
Hmm. Yeah.
people just are going to be taken so off guard by this. I mean,
I
I
know.
talk to people that I know are not up on this stuff, and I'm always throwing out baiting questions to see what they know and where they're at. It's just so dismal. People have no clue what they're facing, what we're facing here.
Hmm. Hmm. And, you know, with everything that's happened in the US, can you explain how that relates to Canada and how that will affect Canada? I saw a headline yesterday that said, "Oh, how the pause of interest rates in the US will help Canada." I'm like,
Mm.
okay, can you
Yeah,
explain that?
I'd
Like,
love to hear the finish of that statement, how it's going to help
yeah,
us.
yeah. So,
Well, generally, I find Canada and the U.S. kind of work in parallel. Like we don't. Canada, U.S. makes a move, Canada makes a move. U.S. makes a move, Canada makes a move. We raise interest rates. You know, they raise, we raise, they raise. Now, occasionally we do divert from them. It looks like there's a bit of a diversion right now. Canada raised 25 basis points. Looks like the U.S. is going to pause.
mhm,
But generally, I find they move correlatively. I always jokingly just say we're the 51st state or
I know,
50
yeah,
states or 50. Yeah, I think we're the 51st state. Um, you know, so US, you know, catches a cold and we sneeze, you know.
yeah. Hmm.
Um,
So we're going to see the effects of all this too, for sure. Like it ends up following up here.
they'll manifest themselves differently, but they're generally going to be the same. Like we're culturally a bit different, and culturally we're not different enough to make a difference in finance, but our banking systems are quite a bit different. I mean, we have the big 6 chartered banks and a few credit unions, a few smaller banks, right? So it's a little bit more, and the shenanigans in our system are a little different. They're a little bit more subtle than they are in the US system. They're more brazen and out in the open down there, I think,
Yeah.
with their you know their foolish moves. Here we try to, you know, um, we try to call it something else. We try to rename things, but we're doing a lot of the same things. It's the same
Mhm.
system generally
Yeah.
worldwide. Banking is
Hmm.
banking. There's a slight variation in regulations, but it's the major dictates are coming down from the Bank for International Settlements. So worldwide, everybody's kind of doing similar things, at least from a central banking hierarchy, and that's really what we're talking about here. They determine interest rates and all this high level policy, right?
Yeah. Yeah. And I think too, this is why you and I follow the US a lot because it is, again, another indicator, isn't it, really?
Yeah, and the reason I follow the US is because we're just going to follow suit anyway, and there's more news down there. It's a bigger population and they're more revolutionary. I've said this before, and they're
Yeah.
more likely to stand up and speak and point out the things they don't like. Americans are just a little bit more forward that way. So I rely on their news because I figure whatever happens there is going to be very similar here. It's just there
Mhm.
might be a time delay. We might be doing it simultaneously, but it's going to look very, very similar.
Mhm.
So this is
Mhm.
why if you're wondering why we constantly talk about the Federal Reserve and the U.S. and there's more information, more people talking, and
More being
it's a
revealed.
parallel.
Yeah.
So yeah,
Yes.
I've had people ask me that question before. Why do you focus on the states? We live in Canada. You know, well, because it's same game,
Yeah.
same
We
game.
focus a lot on the States. Yeah. Along the same lines and in a similar apocalyptic fashion, Morgan Stanley analysis forecast a peak to trough commercial real estate price decline of as much as 40% worse than in the great financial crisis.
Well,
Meanwhile,
I
Meanwhile,
think they
analysts,
dropped 8%. Sorry, go ahead.
okay. Meanwhile, analysts with Goldman Sachs and UBS tend to suggest that the risk ahead is largely limited to office sector as it faces rising vacancy rates and falling property values. But I have to ask you, Tom, do you really think it's limited to office sector?
No.
Okay.
No, I mean, this is the thing about credit. Our monetary system is sort of like a pool. And everything that happens to each dollar in there happens to every dollar in a sense. Now, you know, there are exceptions to the rule, but what's happening in that commercial sector is going to bleed across, because many of these companies, it comes down to the company level. Many of these companies have assets across different asset classes. If their balance sheet gets hit and they get hurt, it bleeds across into all of their asset classes. And if they're, if they've got, commercial office towers and they've got some residential over here that they're doing an Airbnb, maybe possibly, and then they've got some other commercial, like smaller commercial, different, it's all going to get affected. To varying different degrees. They may shunt some assets from here, asset value from one section of their balance sheet over to others and shore it up. But different companies are going to do that in a different way because their prize assets are going to be different. So it tends to hit the whole spectrum, in my opinion, because it's more on a company level. These big institutions have huge balance sheets of different types of assets in different segments. I, a year ago, did a video, and there was as I've been expecting the commercial sector to get hit, and so I did a video on it, like prelude to it, and talked about derivatives. And I was talking about one derivative pool that was not high rises, it was malls. There was 38 malls in this pool, this derivative, and 37 of them were insolvent. So don't tell me it's just office towers.
Right. I remember that. Yeah.
And I listened to an analyst yesterday that said that is actually a myth, that it isn't just the office sector, it's the entire spectrum.
Yeah, like you said, everybody's going to feel this. I mean, it's across the world and all different sectors.
Well, I think the 08 collapse was even bigger than we know. And naturally what you're going to do in a situation like that is you're going to, if you got to cut the lifeboats off the ship to save the ship, you cut the lifeboats loose, despite the fact that they could save your life later. This is what they'll do. They just got rid of some of the bad assets, shored up some, used the good assets from those institutions to shore up a little bit of, the balance sheet of other institutions. But that's not really a fix, is it? It's not fixing the problem. It's reducing the size of the footprint. And I think that's why we're in the situation we are now. We kicked the can down the road. Now the can's heavier.
Yeah.
So we'll see how that turns out. It can't be good. Cannot be good. But residential, on an individual level, is also being hit too. It's just credit and banking is being hit across the board. It's just a matter of to what degree your exposure is to it.
Yeah.
So, yeah. Any more in that article? Any more?
That's it.
That's pretty much it. Yeah, I think we've covered it. So yeah, the commercial sector, keep your eye on it, folks. It's going to be the big news, I think, that they're going to have to eventually admit. And, there's various different things the last 3 years, with, people working remotely has sent people away from the buildings. And so that's caused another issue. There's a lot of dynamics going on here that are kind of like never happened before, type of dynamics. So it's creating a lot of confusion for people to try to establish a baseline for where we're going next. But it's messy, very messy. Yeah, here we are, more doom and gloom. It's not really doom and gloom, folks. It's news. This is if the news is doom and gloom, then that's where we are. That's what we have to deal with. So no happy high notes today. Yeah. All right. Thanks for listening, folks. Have a great day. See you soon.